Index funds or ETFs? Which one should you go for? If you've ever searched online for how to start investing, you've probably seen both mentioned as smart options for beginners. But here's the truth. Even though they might look almost the same, a few small details can make a big difference to your results over time. In this video from Alex Finance, we're going to break down what each one really is, how they're similar, how they differ, and most importantly, which might actually be the better fit for your investing style. And just a quick note before we start. This video is for educational purposes only and not financial advice. Now let's dive in and make investing a little easier to understand. Let's start with the basics. Both index funds and ETFs are built to track the performance of a specific market index, like the S&P 500. That means instead of picking individual stocks yourself, these funds let you own a small piece of hundreds of companies all at once. It's like buying a basket that automatically includes all the biggest names in the market, instead of picking fruits one by one. So, when the market grows, your fund's value grows too. And when it drops, your fund reflects that as well. In short, both are great for long-term investors who prefer steady, low-cost growth without the stress of active trading. Imagine you want to invest in the stock market, but you're not sure which company to pick: Apple, Tesla, or maybe Coca-Cola. The truth is, no one really knows which single stock will outperform. That's where index funds come in. An index fund is like a big basket holding pieces of hundreds of companies, usually designed to track a major index like the S&P 500. So when you buy just one share of that fund, you instantly own a small piece of every company inside the index. You don't need to guess which stock will win. If the market grows overall, your investment grows with it. Index funds don't have expensive managers trying to beat the market. They just copy it. Fees are much lower than those of traditional mutual funds. Most index funds charge an annual fee known as an expense ratio, typically between 0.02% and 0.20%. So, if you invest $1,000, your annual fees could be as low as 20 cents up to $2. That's because index funds are passively managed. It's important to know that index funds are priced only once per day. At the end of each trading session, the fund determines its net asset value, or NAV, which represents the average value of all the stocks it holds. Regardless of when you place your order during the day, the transaction will use the fund's end-of-day price. One more notable advantage of index funds is their tax treatment in certain countries, which can be favorable for investors. For instance, in some jurisdictions, you can move from one index fund to another, such as from an S&P 500 fund to an international stock fund, without creating a taxable event. This means you aren't required to pay capital gains taxes right away when you move your investments from one fund to another. Naturally, this depends on the tax regulations in your country, but it explains why index funds are commonly held in retirement accounts and other long-term investment portfolios. Because of this tax flexibility, index funds are particularly attractive for retirement planning and long-term investing. Index funds are offered by major fund providers like Vanguard, Fidelity, or BlackRock. Different fund management companies follow their own rules regarding the timing and execution of your orders. Typically, index fund trades are executed once each day, using the fund's closing price for that session. No matter the time of your order, it will be executed at the fund's end-of-day price. Simple, predictable, and transparent, exactly how long-term investors prefer it. Now that we've gone through index funds, let's dive into ETFs, or exchange-traded funds. They can look very similar at first. Similar to an index fund, an ETF lets you invest in hundreds of stocks or bonds at once. For instance, an S&P 500 ETF includes shares of all 500 major US companies. So, you're instantly diversified across the market, but here's where ETFs stand out. They trade on stock exchanges just like regular shares. That means you can buy or sell them anytime during market hours, and the price changes throughout the day based on supply and demand. Compare that to index funds, which only get priced once a day at their net asset value, and you can see how ETFs give investors more flexibility and control over when they enter or exit a position. While most ETFs are passively managed, meaning they simply track an index like the S&P or the Nasdaq, there are also actively managed ETFs. These are funds where professional managers try to beat the market by hand-picking investments. Some investors like actively managed ETFs because they let you target specific ideas or sectors. Actively managed ETFs can offer higher potential returns, but they come with higher fees and more risk. Passive ETFs are simple, low-cost, and perfect for long-term investors who want steady growth. For example, consider the Vanguard S&P 500 ETF, ticker VOO. It's designed to track the S&P 500, meaning it's passively managed and reflects the overall market performance. Next, you'll see something called full replication, meaning the ETF actually owns nearly all 500 stocks inside the index. Then, check the expense ratio. For VOO, it's just about 0.03%. Which is incredibly low. Another key point, dividends. VOO distributes dividends, meaning investors receive cash every quarter. Some ETFs, however, reinvest those dividends automatically instead of paying them out. These are called accumulating ETFs. They let your investment grow faster over time. ETFs are traded on the stock exchange, just like regular company shares. This means you can buy or sell ETFs throughout the day, just like any stock, at real market prices. The price you see moves as traders buy and sell, creating instant liquidity and easy access to your money. That's one of the biggest advantages of ETFs compared to mutual funds, which are priced only once per day. So, if you spot an opportunity or need cash fast, ETFs let you act instantly without waiting for end-of-day pricing. Just remember, there's something called the bid-ask spread. It's the small gap between what buyers pay and sellers ask. The smaller it is, the better your trade. ETFs are famous for being low-cost investments, but not all costs are visible at first glance. Every ETF charges something called an expense ratio, a small annual percentage that covers management and operating costs. For most index ETFs, the expense ratio is usually below 0.1. That's incredibly cheap compared to traditional mutual funds. Actively managed ETFs usually charge more, often 0.3 to 0.5, because professionals are constantly researching and adjusting the portfolio. These percentages might look small, but over 10 or 20 years, even 0.5 can cut thousands from your total returns. Before buying any ETF, always check the expense ratio, trading fees, and total cost of ownership, because saving on fees is like earning more money. Both index funds and ETFs are amazing tools for long-term investing, if you understand how they work. ETFs offer flexibility, real-time trading, and access to global markets, perfect for investors who like control. Index funds are simpler, more automated, and great for people who prefer a set-it-and-forget-it style. The real secret isn't choosing one over the other. It's about staying consistent, investing regularly, and keeping costs low. Markets will always move up and down, but time in the market beats trying to time the market. So choose what fits your strategy, stay invested, and let your money work for you. Don't forget to like, subscribe, and share. You're helping Alex Finance grow and empower more investors. Once you've chosen between index funds and ETFs, the next step is managing risk and maximizing your returns. Diversification is key. Even though both index funds and ETFs already spread your money across many stocks, you can further reduce risk by mixing US and international funds or by adding bonds. Another key strategy is reinvesting dividends. Some ETFs and index funds automatically reinvest them, allowing your money to grow faster through compounding. Consider your investment horizon. The longer you stay invested, the more time your portfolio has to recover from short-term market fluctuations. Avoid trying to time the market. Focus on consistent contributions and low-cost investments. They often outperform frequent trading. So, what's the final takeaway when choosing between index funds and ETFs? The truth is, there's no single answer. It depends on your goals, your investing style, and the tax rules in your country. The most important principle is to stay invested consistently, focus on low-cost options, and think long-term. Time in the market often matters more than trying to time the market. Review your portfolio periodically to make sure it still matches your goals and risk tolerance. Combining both index funds and ETFs can create balance, stability with flexibility. Don't let short-term market ups and downs distract you. Patience, discipline, and smart decisions are what truly help investors succeed over decades. Keep learning, stay consistent, and let your money work for you over the long run. Thanks for watching. This is Alex Finance, helping you build a smarter financial future.